All right, sorry about that. Let's get into this strategy meeting. This will be the February edition in which we will bring our trader team on. In fact, we got a new member of the trading team that's going to join us today. We'll get to him in just a little bit, but I want to welcome everyone into this meeting. For those who may be new, this is where we bring our team together and we discuss the themes that we may be seeing playing out over the next 3, 4 weeks or so. We are in the midst of earnings season and we got a lot of big data that's coming out next week, in particular the CPI. And I think this is a good time to have this meeting because we are really at a crossroads in this market. I'm going to bring in Brett Manning to have a little bit of a discussion here, aka chart trader. Now, Brett, you could make a case for both sides of the market. You've got one camp that would be saying that, hey, the bear market's over. You got another one that says, hey, we got some more room to go to the downside. I bet you can make an argument for both sides, Brett.
Yeah, hey Jim. Yeah, so and it's interesting to do that. I always try to do that. First of all, I would recommend it. Try to get an understanding of how you could see the world evolving to create either outcome, so you can start to compare the two. It's a useful exercise, and right now I think you're right. I think it's even more useful than usual. So from the bear side, the main arguments right now I mean, the really important thing is resurgence in inflation, or probably would be a big compression in margins over time. And that basically subsumes the valuation pricing argument that people would also make, because basically we've seen downward earnings estimates revisions that maybe hasn't been priced in fully by the market. But I would say you have to remember right now, forward earnings estimates are not going to be reliable. Like trying to forecast Q4 2023 for just about any company is probably pointless. And just to give you an example of why I say that, imagine a world where CPI next month is back at 8%, and the Fed has to shift its dots, and we start to see a terminal rate of like 7% on Fed funds. And we walk into a hard landing in Q3 without a big drop in inflation. In that world, Q4 is going to be just an absolute wreck for everybody. Compare that with a world where CPI persistently drops without much economic deterioration. So effectively like a vindication for team transitory. And let's say we're at 2% CPI in September. We've got strong GDP growth. I mean, Q4 is going to be huge. It's going to be amazing. And both of those worlds are clearly possible as it stands right now. And we really don't know which one we're going to see. And we're probably going to see somewhere in the middle there. But there's enough kind of volatility of the forward outlook because of how things could evolve just in the next few months right now, that looking at the total of 2023 earnings is just it's I think it's kind of a fool's errand to say that and you can really say we can reliably forecast things based on valuations that are based on forward estimates. So take that out of the equation, and the bear argument is really about where inflation goes. And I can make a case that inflation is going to head back up very, very easily. We've seen this real moderation in inflation, but it's been almost completely dependent on a decline in goods pricing and a decline in commodities. And services inflation has pretty much stayed right where it is. And those first two tend to be mean reverting, especially if the economy doesn't weaken too much. With the jobs report we just had, we can expect people to feel a little more flush. We can expect goods prices to possibly stabilize rather than dropping 10% a month. Um, we're seeing commodities already start to turn around. So if we get into the next few months and services inflation does not come down, and you see goods pricing bounce back, you see commodities bounce back, we're going to be right back at 7.5 CPI. So that's already a big possibility that's sitting there right now, and that would lead to that sort of worst case scenario. And that's your real bear argument, is you start to see something like that happen. And that's going to lead, in the end, when the Fed has to tighten to 7.5% Fed funds, that's going to lead to a crumpling of end demand, but you're still going to have the supply issues. So you're going to see what Gavin and I talked about last time, where you get these margins that just compress to nothing. And that's your Q4. And everybody's just, I mean, there's the next leg of the bear market as we go over that hill. So that's not a hard argument to make. But on the bull side, I would make a couple of different cases. One of them is simply the sentiment and breadth signals that we're starting to see right now. And they're very, very compelling. And as I said to you before the meeting, I'm actually at this point on the bull side. If we see the inflation picture deteriorate the way that I just described, that will change that. But as it stands, there's two big signals right now that are just they're hard for me to get past. One of them we talked about a lot last month, which was the super extremes and the buy to open put call ratios for both retail and institutional market participants. They were both at levels, Robo and Lobo. They were both at levels that have almost always called major bear market bottoms, and they pretty much don't happen under any other circumstances. It's not ambiguous at all, and they're data points that I trust. Now, if I'm going to play devil's advocate to that, the options market has evolved a lot, as I'm sure options trader can talk about. The options market has evolved a lot in the last half decade. Participation has gone through the roof. All of our highest options volume trading days have happened just in the last couple of years. We've got a new generation of people who are completely involved in the options market. It has shifted in a lot of ways that may make those data points apples to oranges. So that's a little questionable, but its long-term track record is extremely good as a signal. And the other one I pointed out yesterday is what's called the McClellan Summation Index, which is basically taken from the McClellan oscillator. It's a breadth signal. It uses two different moving averages of breadth. It very rarely gives a particular signal. It just gave this particular signal. The signal is the summation index crosses above plus 1,000 after declining below negative 1,000 in a sequence. That's only happened 18 times since 1962. And the market was positive after 3 months every time but one, and that time it was flat. After 6 months every time but one, and that time was flat. After 12 months every time across the board with gains and a lot of them large gains. And you can look at a plot of the S&P over time and put a dot every time this has happened. And almost all of them are following a bear market in the few weeks or months after the end of that bear market. And there's not one instance where we've had an established bear market and this dynamic has happened in the middle of that bear market before a new leg down. So it's a large sample size. It's completely unambiguous in its outcome distribution, and it reflects a really deep and broad sense of breadth underneath the market across all of equities. So it's taking a lot of data. It doesn't happen that often, but it's happened enough to say this isn't just a crazy fluke. It's not like we got 3 of these signals. I mean, 18 times is substantial enough given the number of bear markets we've had. And it's never once produced that false positive signal. And basically, it's produced every correct positive signal. So that's a data mining figure, though. If I'm going to play devil's advocate again, when you data mine, there's always some reason for skepticism because you can backfit things to fit. At least it's big round numbers. It's plus 1,000 versus negative 1,000. If I saw something like this and it was plus 962 versus negative 623, I would know somebody's done a lot of work to try to find some crazy instance to make a clickbait post on Twitter. But this is, I think, a very substantial look at what's going on underneath the surface of the market. Probably the bear side wins if the inflation argument turns in the negative way that I described, but otherwise there's a lot of things that are starting to stack up. And we've seen a persistent period of very negative sentiment in the market. That's usually a good foundation for people to be surprised by a wall of worry. All those factors are kind of lining up. But again, yeah, Gavin, I'm sure, is going to talk a lot about the inflation situation. We've got CPI coming up next week. We saw a bad UMich number this morning. We saw the CPI revision upward for December, and we've got this problem where the moderation we've seen in inflation data looks a lot better on the surface than it does when you dig into it a little bit.
All right, I got a lot of questions for you here. The
Go
first
for
one,
it.
do you have any charts that can show us the points
Yeah,
for that McClellan oscillator?
absolutely.
And if you don't have it handy right now, at least we can go back and maybe I can put it in the details section of the archive of this one. I think that would be pretty handy to use. But while I'm thinking about it, we're also going to be going up against some pretty, I guess, easy comps for inflation coming up, wouldn't you say? So that probably
Oh,
helps the bullish
absolutely.
case.
Yeah, right. Well, so sure. And of course, if you get, so in other words, what you're saying there is that if the year over year data is going to look better and
Mm-hmm.
better if the month over month data is just average.
Mm-hmm.
And that's true because we're coming into that period where we saw this really skyrocketing numbers for March, April, May, June, where it was really terrible, like 1% month over month up. So yes, definitely got that. But the Fed's going to be looking at this kind of rolling version of that, and you're going to see, where are we for, like 3-month annualized versus 6-month annualized versus 9-month annualized, because I mean, the trend is that's like you could trick somebody in the Wall Street Journal who doesn't follow the market with that data point. And yes, you can get to making big picture cases like we could be at 2% by June if this keeps happening. But people who are looking into this a little deeper, if we see the 3 month trailing trend start to inflect back up, and it's because we don't see any bend to what's going on the services side or the supercore services side, then that's going to impact markets more than the superficial read on annualized based on comps, I would say.
All right. So I'm going to invite Gavin into the conversation because one of the things that I want to highlight here, Brett, and I'm going to play a little bit of devil's advocate on my Trader Audio screen. You'll see the AAII that came out I guess Wednesday night, Thursday morning,
Right.
and we saw a pretty significant shift uh, from bullish and more
Well,
less
back to
bearish.
neutral historically, though.
Right. So, but Gavin highlighted that the last time we've seen a shift like this was back in June of last year, and it came just prior to the CPI number that came out, and then we saw a
Hmm.
12% decline. So,
Oh
Gavin,
yeah.
I'm going to give you the floor on this one.
Yeah, well, Brett and I have certainly been talking a lot about the extremes in bearish sentiment that have been going on, and that's what was so eye-catching about that AAII read, where we had the biggest pop from a week-over-week jump since June, like you were just talking about. Also, we were seeing some of the highest readings in the bull sentiment and some of the lowest readings in the bear sentiment that we had seen going back to 2021. The bull bear spread itself at plus 12.5% had been the first time it had been positive since March 31st of 2022 and the highest since November 11th of 2021. So that sentiment was definitely coming into play here, and we saw it play out given that rally. What Nasdaq's jumps 12% year to date or whatever it is at this juncture. So a lot of people were starting to pile in, and the question that I was having was how much of this was short covering, how much of this was just kind of repositioning on those beaten down tax loss selling names, and how much of it was real buying that was going to be sticking around for an extended period of time and providing some support. Um, that's still open for debate, but I thought that there was enough there that could lead to a little bit of a shakeout. And then from there, you're kind of looking for the headlines that could do that. And as Brett was talking about, inflation sets up nicely on that because I really think that people think that the disinflation story's been put to bed and that we're just going to continue to trend down. Rarely do you see just a complete a trend go completely in one direction without the occasional hiccup here and there. And that's what people are kind of looking for coming up next Tuesday when the CPI print hits, because there's two data points that popped out early that aren't widely followed, but certainly factor in here, and that's the Manheim used car index, which came in hotter than expected, and the other would be just an anecdotal piece of higher rents going on in New York. You saw January record high rents. Now, that's not going to be indicative of the rest of the country, but when you're kind of looking at where the pricing pressures have eased, as Powell has said, it's been on goods. Used cars has been a pretty big reason for the decline in inflation. Lower housing rents and housing prices have been another key component of that. So, when you see those two move up, we really haven't seen any sort of services decline at all. So that's ramping up the anticipation that maybe CPI, we break the string of 6 straight months where we've seen a year over year decline coming up. So, that's kind of getting factored in here. And I think one of the reasons why we've seen some of the selling pressure creep back into the markets. Now, there is the aspect, like you were saying, Jim, of the year over year comps getting a little bit easier, and that will certainly play in. But that kind of factors in a little bit deeper into the summer months, I think, where that really starts playing. Those easier comps start rolling in. So we have seen the market position for that, though. The CME Fed funds futures have been on the uptick here. We've talked a lot about that, the rise in the terminal rate expectations, the rise in the end of the year expectations. So that has started to get priced in by market participants, which it could set up for a possible little buy the dip if we did see a hot CPI print come in. But in addition to CPI next week, you're going to have the Empire survey. Everybody's going to be looking at that prices paid number, PPI, Philly Fed, and the inflation or the import export prices are all going to be out. So inflation is going to be top of the mind going on there. Now, U of M have gotten us off to a little bit of a poor start here, and I think that's going to act as a bit of a headwind for the markets here and make it very difficult for us to press any higher until we get past that CPI print as well. Uh, the other factor that's kind of working its way into the market right now is you saw that pop in oil prices, which had been another big drag on the inflationary pressures. Certainly, everyone's been talking about, gasoline, that gas on the decline, oil on the decline, and that should drag down some of the inflationary pressures. But little pop today is as Russia's cutting its production by 500,000 barrels, and the other backdrop to that is there's a lot of rumblings about a spring offensive coming from the Russians as well, which is going to put nat gas prices back on the radar. Food prices with Ukraine with its huge wheat supplies on the radar. So all these are going to start getting factored into things that might make it won't seem as clear cut as that we're in a disinflationary environment because we're going to probably hit a path where we're seeing a little bit more choppier sideways activity, which is fine. We see it all the time in any chart that we look at, and it's typical. But considering how the market's kind of gotten ahead of its skis, that's going to really bring in an important talking point for us. We've seen the Fed members really hammering home the idea that the market needs to be more careful on inflation. A lot of talk, obviously, about how the market's been dismissing this. Perhaps they won't be able to dismiss it as easily if we get a bad round of data next week. So now the flip side of that is the way I see this is more importantly a correction in the upward move and a healthy correction at that. I think we're kind of at that um, that weekend parabolic run that has a lot of leveraged players in and a lot of FOMO traders that could be viewed as Brett likes to call them, the weak-handed longs jumping into the markets. And, that just kind of needs to be scraped off the level until we can find a firmer support. And then you start looking at what Brett was talking about with the breadth of the move and the positioning that still remains in favor of the bulls. So very immediate term, I'm a little bit cautious. I thought the team did a fantastic job at jumping in on shorts and playing puts yesterday, and we really did some justice to the subs, in my opinion. I think that's an environment that could remain in play for the next couple of sessions here until we get through some of that headline risk that's potentially coming down the border. But at the end of the day, I see it as a welcomed correction to the early move. And then, it's like Brett was saying, it's going to be all about the magnitude of that inflation impact. Certainly, the Ukraine backdrop is going to be an unknown that you simply can't predict what Putin's going to do there. But there's enough out there to give markets a little bit of a pause from that early run. But again, the positioning remains in favor of the bulls, and that's got to be respected if we start seeing support come in.
One thing to add to Gavin, just on the AAII. So the June signal, is right about where it was, right in front of it, and what happened afterwards, and certainly that there's a correlation there. But one thing I will say is the difference is this time around we saw a period of a good 8 to 10 weeks where I would say it was legitimate. What I look for, legitimate festering in extreme bearish territory before this moved back to more neutral levels. And I don't think that was the case when we came into June.
All right, Brett.
Well, Brett, as I was saying, it was all about the pop, right? So, just we were down around that 25 area in the AAII survey, and that's when we saw that big jump come in. So, I
But were
don't
we
think
there for 2.5 months?
let's let me do a
I
quick
don't think
check
I
on
don't
that
think we
because
were. I
I
don't think
think
we had gotten
that's an
that level
important.
of extreme signal from that indicator. I mean, maybe we had actually, but
Yeah, no, I'm popping back right now. I'll be able to look this up because that is a good point.
I mean, it
And
really is about
the reason
sustained
why
a
June
sustained
jumped
print in a zone.
right, the reason why June did pop out to me was because of the fact that, that was the last time we saw. I think it was about a 700 basis point jump from in the bullish read. I'm just trying to download this number
And on a
here
relative basis, there's no
because
question. What you're saying is exactly true. Like there was a relative shift, and there was a relative shift this time in terms of sentiment, and it shows up there.
Right. So as we know, the bullish sentiment on the 8-week moving average has been running around 25, right? Going into that report, if we're just looking from the month of May through June before we saw that pop, the 8-week moving average, and that was a pop of 13 points. The 8-week moving average was running right in that 25.08
Okay.
to 25.88 area. So actually, we had been festering down there below. We had a couple of reads. There was bullish sentiment reads of 15, 18, and
Okay.
16
Yeah. Okay. Well, then that's
in the
legit,
middle of
right?
April. The bullish read was 1985 on May 26th, and it jumped to
Okay.
3202 on June 6th,
Yeah. So it's a
2nd.
very, very
Now,
similar instance. Yeah. So if we get a
now,
terrible CPI print, let's get short, big time.
yeah, and now here's the interesting thing about that data print. Talk about an outlier. It fell 1,100 basis points after that to 21%, and then 19%, 18%, 22%, 19% following 5 weeks. So that was just a real big blip out of nowhere
Right.
on that June 2nd reading, which is interesting. And then you
And
saw
sentiment's
that
been
eight
very
week
volatile. Yeah.
Exactly. And then you saw that 8-week moving average actually dip down to the 22% area, which is certainly about as the extreme of reading as we'll see. We probably have to go back to the great financial crisis to find it running around in that 22 area in the weeks that followed that pop.
Right.
Now, here's the thing. It very well could play out just as Gavin described. We might see a short-lived sale in the market, and then you might see a reaction like you did from the University of Michigan number today. What do you think handicapping the odds of that, Brett?
I think it's very possible. Again, you've got a lot of signals suggesting that people are underpositioned in a market that started to show some really positive signs under the surface. But it really comes down to, I mean, what we see, it's underneath the surface. Like the devil's going to be in the details with the CPI number and any inflation data point that we get, because it can either reinforce or discredit this narrative that we've basically seen a kind of an illusion of a moderation in inflation that could easily, you could see a tailwind turn into a headwind, and it was a mirage, you know. And the Fed is suddenly right back to the point where they're just chasing things over a horizon, and we really don't know where the stop is. And that's the bearish view. That's what we got in June, was the idea that it doesn't matter what the terminal rate looks like right now. It's just the idea that they're chasing a moving target, and it could be 10%. Fed funds could be at 14%. Like we saw in the late 70s, early 1980s. Like they're chasing something that's moving, and when you don't have that second derivative shift, and you see that we can define a trend now, we understand where the boundaries of it are, and we can start to predict things with certainty. It just puts it back in this sort of open-ended zone if a tailwind becomes a headwind, or, well, let's say from the standpoint of inflation, if a headwind becomes a tailwind, and that open-ended feeling is what really causes the market to tank.
All right, Brett. So I got one more for you, and Gavin, feel
Okay.
free to jump in. And that would be, so based on what you said, you're in the bullish camp right now. How do you play it? How do you set up for that? Since this is a strategy session, let's talk about the strategy, how to run it.
Well, I mean, I've got some exposure, and then it's just about playing setups. And so when I have a directional bias, I have a specific kind of playbook of setups that I use, and when I see them, I take them. And if I have sometimes I don't have a directional bias. If I don't have a directional bias, I'm taking them in either direction depending on how much conviction I have in the setup. If I have a directional bias, then I still need the setup. So I'll just need to see situations and patterns and tone underneath the surface of the tape. And if my tape reading and my pattern reading line up, and I've got one of my setups and it's in the direction of my directional bias, there's an opportunity. And it just comes down to what sort of tape I see. But it is a directional bias right now for me. But as we've been talking about, it's highly contingent upon what we see on Tuesday and what the details are.
All right. So fair enough. We'll probably safe to say you will be somewhat quiet until after that number?
It depends on the setups.
All right.
I could easily see if I see a great setup, I'm taking it no matter what's going on.
Hmm.
So I just, and for me, a lot of that's pattern based, and I know when I see it. When I see it, I go, oh, I know what's going to happen now. I'm going to put the trade on.
And I would just add on to that, just, this is an environment where you need to have some flexibility, and it's, that's why I've been kind of flopping between the long and short here. Personally, I'm eyeing up the pullback in energy and healthcare as a space where if we do see a dip and then a move back higher, I think we'll see more people moving into that space, given the concerns around rates still lingering likely and the volatility in the tech space. And considering that they've already had a big run, I think people will see more opportunity in some of those cyclicals.
All right, Gavin. Any other sectors that you like? I know you just highlighted energy, but anything else?
Well, given how strong the jobs market is, and that we haven't seen any issues on the rise in credit issues, I think the financials set up nicely here. Cheap valuations. Haven't really seen a drop off in economic activity. Certainly haven't seen the uptick in credit, as we just said. So I do think that the financials in a rising rate environment, especially when we get a little bit more under the table of an end is in sight in terms of a terminal rate, that's when you'll start seeing that yield curve start to move back and slow and steepen, and that would obviously greatly favor the financials, which they haven't had that as much of a tailwind as of yet because of the inversions that we've been seeing the last couple of months. So they would be areas that I'm looking at on the long side.
All right, Gavin. Well, let's bring in Craig. You know him as Trend Tracker. Craig, you've had some pretty nice shorts on some of those big names like Nvidia and Microsoft lately. You've actually had a pretty good track record of getting some pretty good shorts on lately. So, what are you brewing up in the lab back there?
Um, I've kind of made it a year that I remain cautious, and that was basically on the wrong side for the first 5 or 6 weeks up until basically a couple days ago, right? Um, so my view hasn't really changed. I feel like I need to be a little bit more patient, trade and looser swings. Apple short last week. It took a while to play out, but it would have worked. Didn't think last week's move was sustainable. Eli as well. I'm just trying to take little stabs, and I know that style is more just being patient and giving stocks perhaps seconds or weeks to kind of play out. So I got pretty lucky yesterday with the Nvidia short. I risked 3 points, so I wasn't risking a lot, which is nice. I know a lot of our traders rightly are focused on reward, and they don't want to take trades where I'm starting real small. I plan to tail in, which may take weeks or longer to kind of play out. That is usually where I have to kind of scale into positions. So I avoided getting started on that Nvidia yesterday by like 20, 30 cents. But and I was ready to. I had a that I get stopped out, and I was going to, in the comment, trying to pick a top in stock probably isn't the wisest move. My conviction is that this strength isn't sustainable, but we've seen a real bubble, not only in I like to refer to it as a rebubble almost, and these tech stocks, and AI is kind of a big theme, right? So you can easily argue that this AI theme is a lot stronger than the metaverse we saw. Was it late 21 or blockchain back to 17, which came back during the pandemic?
Hey, Craig,
which, you know, could theoretically just keep going.
yeah, I hate to cut you off, but your internet or something going on is really making you break up. You're very matrixy.
Interesting.
I don't know if there's
Okay.
anything that you can check. But
You
how about
know, okay. Yeah, listening to the call every couple minutes kind of cuts out for a second or two, but otherwise
Hey,
the
Craig, do you have a
hearing is fine.
hotspot?
Am I on a hotspot?
Do you have a hotspot?
Mm,
No. Okay. Sometimes that helps me when that happens. Switch to the hotspot.
all right? I have one
don't think
question
it's
for you.
Wi-Fi.
Are you able to hear me, Craig? And hopefully you
I
can
can
get
hear
through
you
now.
guys fine.
Okay, so the question I have is, with the momentum in the AI names that we're seeing, it's kind of getting meme-like. Shorting a name like NVIDIA, is that risky to you based on the fact that a lot of their chips uh, are in the AI space?
You know, yeah, it's. I've said it for years now. This is the best way to play NVIDIA. So the wise move a few weeks ago was to just kind of get long and participate in this bubbly activity. You know, I do expect consolidation ahead of the next print, though, because there's risk estimates. You know, the demand can be stronger in terms of the long-term potential is fantastic with you know this being a core piece of hardware for AI, and but you know, I expect consolidation ahead of the next print because the gaming cycle still stinks. So there's risk to now near term as everything AI is bought up, right? So, you know, yesterday that's why I put out a tight risk and lucky that you know it worked, right? So yeah, you know, it's I could have started to try to scale into this Nvidia, and I would have been you know sweating here over the last week or two. But at you know this week it kind of the two, especially in the broad market. So you know, if I got out yesterday, I probably would have, you know, shied away, and I've been able to from that trade this morning. Um, yeah, I mean, I just view a lot of this euphoria that we saw to start the year as unsustainable. The market is not active, especially when you can get 5% in term treasuries. Gavin did mention, you know, Russia is building up troops again. Um, and we've been hearing for weeks now, spring of it's, you know, I don't think there's a real question at this point. So, you know, if we have a 2% down day because things start to get real ugly again in Ukraine, of the technical indicators that are very encouraging right now could go the window. So I don't want to disrespect the tape trend in price, but I like the fundamentals are an anchor that we have to come back to, and I just don't see it yet. But it's only possible. Soft landing potential continues to increase if inflation keeps coming down. So obviously Tuesday will be a huge day.
All right, thanks a lot,
You
Craig.
guys get any of that?
Yeah, most of it. We got most of it. I do appreciate it, but I'm gonna jump a little bit here. And if I had a drum roll button here, I'd be playing it right now. And that means I'm gonna introduce the new guy. And you know him as options trader, OPTNX. His name is Brandon Mars. I'm gonna give you the floor. Brandon, welcome aboard.
Thanks, Jim. Can you hear me okay?
We can hear you just fine.
All right, perfect. Well, I definitely wish I had that drum roll. I'm a little disappointed, but I appreciate the time today and glad to be aboard.
Well, I'm sure everyone wants to get to know you a little bit better. So why don't you give us a little Cliff Notes story of your trading background, how you got into it, and how you got into options trading?
Yeah, so my interest in stocks actually started back in college. Basically, I went to school with a bunch of pretty wealthy kids, and you know, I come from a pretty moderate family. My dad always took very great care of us, but you know, we weren't filthy rich, and I had some student loans coming out of school, and I said, how can I pay these off without you know getting an official job? And I started reading about the stock market, and my dad was kind enough to give me a $500 account at Scott Trade to start my trading career. So I've been interested in it since college. And then about 5 years ago, I've been in finance my entire professional career. About 5 years ago, I kind of saw a limited window in what I was doing in the alternative investment space, and wanted to expand my horizons, and got real serious about trading. And me and a friend, we just started teaching ourselves technical analysis and chart watching and options trading. So I basically spent, I wasn't your typical millennial Facebook, trader that jumped on board with COVID. And I spent probably 60 to 80 hours a week learning charts, moving averages, Bollinger Bands, MACD, RSI, volume. Those are typical things that I use, trend lines, Fibonacci levels, and then really just learn the basics of options as well. And that's kind of my style. I understand how to do butterflies and spread trades and selling options, but I do keep it pretty simple. Just buying calls and puts based upon looking for breakouts. So for me, I really like to try and find, triangle patterns, flag patterns, both on the intraday or daily charts, looking for some sort of stock that's going to have some relative strength and potentially a quick breakout. One thing with some of this volatility that I've liked a little bit more lately too is, if you see a momentum tech name, like a Meta or, an Apple pull back to like a key support level and, create some sort of big hammer candle or something like that on some high volume, picking up some intraday scalping options, if you will, on a play like that. So, that's really the background on me.
All right. And I guess what led you to options versus underlying stocks?
Yeah, good question. There's something I'd say a little bit more thrilling about options. If I'm being honest, I treat it very much as a business, though. I'm definitely not, in it for the thrill. For that, I will, go to the roulette table or, bet on the Super Bowl. But I just like the fact that you didn't need to put up as much capital for the trades. For me too, if you're playing the breakouts, if you find some triangle on an intraday pattern and you're only going to be in that trade for, I don't know, sometimes a minute, 5, 10, whatever it might be, until you hit your next level and you exit your trade or roll or whatever you might do. I like the fact that you can put up, $1,000 there and you can potentially hit 100% on that, as opposed to, putting in, $10,000, $20,000, whatever it might be, into a stock trade. So that's really what led me into options.
All right. And I noticed that you do a lot of weekly options. What's the advantage there that you see?
Yeah, so for me, I mean, that kind of comes back to me playing the breakouts. So, let's just pick hypothetically here. I was going to do a trade on, Meta today. If, I see some sort of triangle setup and I think that all of a sudden Meta is going to move, 2 points in 15 minutes. For me, I don't want to pay that extra premium going out a week or two. I'm probably going to be into that trade for as long as I see the momentum there before I start to see the resistance. So, if you've got a triangle setup and you're in Meta and you think it's going to move 2 points and it moves 2 points, I'm probably going to exit that trade, maybe trim, maybe roll, whatever, I'm seeing at that time. But, for me, if it's a Monday and I'm taking that trade, I don't want to go out 2 weeks and pay that extra premium, because I'm just not going to be holding on to that option for that long. So for me, it's really just my particular style. I understand the importance and the benefits of potentially going out a few weeks, and once in a while I will do that. But again, I think it's just kind of the short-term nature of some of my trades.
All right. We're going to take a deeper dive into your strategy next week. But I did want to ask, you do a lot of basic buying calls and buying puts. Do you ever adjust your strategy due to volatility where you'll sell calls or sell puts?
I don't sell any calls ever. I do understand where they work in portfolio management. It just doesn't work for me. I did some covered calls back in the day on some stock positions I had, and I just always felt like I was rooting against my stock so my option would work. So I stopped doing that. And then, I sold a naked call one time. And frankly, this was when I was a new trader and it was on Overstock. And if anyone's traded that stock, it gets slightly volatile. And I quickly learned my lesson of what the risks are of selling naked options. So for me, I did not do that. I mean, actually, Damon and I were talking the other day, AI stock. We were looking at some of the premiums on that, and Carvana, I think we were talking about, and you started seeing 400 to 500%, IV on those stocks. So there's definitely an opportunity, and I said to Damon he might want to think about it, but at the same time, if you sold a naked call on a stock like AI, and they tweet out something or whatever's happening in the headlines with these stocks these days, and that moves against you, it could be a pretty ugly situation. So definitely selling them naked, I take caution on, and the covered calls just didn't work for me. So I tend to shy away from those.
And do you shy away from any stock that has implied volatility kind of outside the range that you're comfortable with?
Yeah, so actually, I was talking to Damon about this too when I first started. So when I look at the IV, once I start to see 100 on the IV, I start to maybe question, whether that's going to make sense. Obviously, like on a stock like AI, it's reached 2, 3, I think 400%, and still you hit like a 5, 6x one day. I saw the other day on one of those options. So you will still get those big moves, and there's money to be made. But once it hits 100, I usually start to ask myself, is there that much movement in either direction? Or what I'll do is, I'll just double check. Hey, are there any events coming up? Any announcements? So sometimes too, that's kind of been an indicator of, hey, an option has 150% premium, and I'll check and I'll see that they have earnings the next day. So, I don't totally stay away from them, but I'm cautious about it because I've been in situations before where I've traded in options contract, and, the stock has moved 5 to 6% in a day. And, frankly, you just haven't made any money on that. And, that's part of the math of options. So I wasn't shocked, but, it can kind of be annoying. So it's definitely something I'm mindful of. Usually those ones that are like 500% plus, I'm usually not touching myself.
All right. So what would you say your sweet spot is in terms of how the duration of your trades?
That's a very, very good question. I mean, you know, I'd say the sweet spot for me is, if I can find one of those, triangle setups, and, you really hit that breakout when the momentum hits, and you're, in the trade for, 30 minutes to an hour. I like that personally because, with options, I think you can sit there, and we do this with stocks too, and say, please come back, please come back. And there's nothing worse than ending your Friday with 20 worthless contracts in your account. So I would say that is kind of my sweet spot. I've got my triangle, I've got my, my next resistance going to be the Bollinger Band, and boom, the market makers step in, the stock takes off, it hits my target levels, and, I trim or roll or exit completely. So that would be an ideal situation, I guess, in the world of options. Easier said than done, right?
Yeah, for sure. There's one thing I want to clear up for everybody listening out there. I know there was a question that said, "Hey, Momo X, what are the few option books that you like to read?" And I'm going to address that to you, Brandon. However, uh, this is OPTNX. Okay, so this is Options Trader. We'll have Momo X on at a different time and get his input, but we'll just take one at a time for right now. That was actually one of the questions I wanted to ask you. What are some options trading books that you have read that would give you some good insight that you would recommend to our listening audience?
Yeah, so options as a strategic investment by Lawrence McMillan, as Investopedia says, the Bible for options traders. I think that that's a good start for beginners. And then if you want to fall asleep,
I know which one you're going to say.
Option Volatility and Pricing by
Ugh.
Sheldon Nattenberg.
Yes.
I don't know if I should be admitting this on the call, but I am not sure I actually have been able to get through that whole book yet. It looks pretty on my bookshelf, but
yeah, you got to keep it there as a staple.
Strategic investment, I would say, would be a great starting point. And I probably wouldn't even go any further than that, because options really are a whole different animal. And I think as you start to learn them, sometimes you realize that they're not for you. I have a lot of friends that have worked in finance with me for years that have said, "Hey, Brandon, will you teach us options?" And I love to teach them. And usually we get about 3 days through the options Greeks, and they're like, "Yeah, I've had enough of this." So I would start there, and then if you really want to, if you like math, especially want to take a deeper dive, go with the second book that I mentioned.
Yeah, well, I don't recommend that book because I've tried to get through it twice, and I technically have, but it's a rough read. Oh man.
You're a better man than I am, then.
Yeah, well, it took me twice to figure that out. So who's the more efficient man here? Anyway, I want to open up the floor for our trading team to ask you some questions. Gavin, what do you have?
Yeah, hey Brandon. I know we spoke a couple of days ago. Definitely great to have you on the team. I love the stuff that you posted on the site. I think it's definitely providing a lot of value for our traders out there. I guess my question is around your some of your philosophies. Number one, what are you tracking in the morning? I know you do a great job at getting out a couple of names out there that you're looking at earlier. Are you just kind of watching charts from the day before and taking notes, or are you looking at open interest in some of these names or the volatility behind it? And then the second question I'd have for you is, do you have a preference between at the money or out of the money puts or calls that you're trading? Do you have a philosophy on that?
Thanks, Gavin. So in the morning, so what I actually do is I look at all of my charts in the afternoon and the night before, and I come in with my ideas. And one of the reasons that I've done that is I try to take out some of the noise from some of the stuff that happens in the morning. So you got to be mindful of it. But at the end of the day, I care about the charts. So I come in with my ideas. So basically, I'm a little fresher in the morning, and I'm not, going through 50 charts. I'm on the West Coast. So at, 5 in the morning. And basically what I'll do is I have, my 3 or 4, 5 ideas, whatever it might be. I will double check to see, the headlines. Obviously, if I come into the day and I say, "Hey, I really love the meta chart," and I wake up to a headline that, the government's going to finally crack down on the metaverse and they're going to break it up into 15 pieces. Well, I'm going to be mindful of that. And then, basically I'll look at, the futures in the price action. If I come in with an idea where I think, I might see a particular bounce in a particular name, well, maybe I'll go and adjust my charts where I'm like, okay, well, things are looking a little ugly here out of the gate. Maybe if Apple gets to 149 versus 150, I'll be intrigued. So, I'll adjust accordingly, but I definitely try to do all of my chart watching the night before. And basically I have a kind of a set list, and those are kind of the main names that I'll trade. And then I'll go and do some screens once in a while to maybe find a new name or, see some really intriguing setup. But, the guy I learned options from, I mean, he only traded like 7 to 10 stocks on his options. And I don't think there's anything wrong with that. I don't go quite that small on the number. But I definitely try to not look at every stock in the universe, especially too, because not every stock has options on it. As far as at the money or out of the money, I'm usually, and actually this morning I said something on Apple, and that was just because the next strike was a little higher than I wanted to go. I'm almost always out of the money. And the reason that I do that is I'm playing breakouts. So, for example, if I'm looking at actually a trade I talked with Damon the other day, it was on Snowflake. It was trading around 150. And I basically said, hey, I'm going to buy the 155 strike. And he's like, well, how come you would do that instead of the 152 and a half? And, we're kind of at the end of the week here and, we're getting close to expiration. And I said, well, right now we're in an environment where high growth stocks are in theory going to move. And this was post Fed day. So we saw that huge move, and its mid Bollinger Band was at 155. And I said, a 3% move on a stock like a Snowflake in that particular environment is nothing. I said, so why would I want to pay the extra premium of the 150 or the 152 and a half when I think it's going to go to 155? Now, in that particular case, it actually went up to 160. So even I was wrong. But in that particular case, I have no problem buying a 155, being correct, and then giving me the opportunity to either exit, or roll up to the 160. So, for me, if I'm playing the breakout, and I'm looking at, going back to like Meta, and I think it's going to move 2 points, I'd rather not be at the money. I'd rather be out of the money and pay less premium on that. And if you get those true breakouts, those out of the money options are going to move quickly. And just to stress, I am not saying to go out of the money in a way of let's get rich. I think that's where a lot of people get burned, is if they go out of the money thinking they're going to pay a penny for a contract and it's going to magically turn into, worth a buck. That is not what I'm doing. If I'm going out of the money, I have a very specific price target or technical breakout range that I think is going to hit. And that's how I select my strikes.
All right, Brett, did you have a question for Brandon as well?
Yeah. Hey, Brandon, how are you?
I'm great. How are you?
Yeah, very good. This is Brett. I'm chart trader on the service. So, yeah, I really liked the material that you've been posting. I really like that your trading strategy from what I've seen, and I especially like what you just said there at the end. Um, you're systematic, you're disciplined, and you're trying to do something that's going to work over the large sample size rather than a desperate chance to get rich in a short time. And that's the foundation of success. And I also would say that I think that from what I've seen, and you can tell me if I'm wrong, I think that you and I might actually have some similar instincts in terms of patterns and the type of thing we like to take advantage of. And it's different time frames, different implementation, but the basic idea for me in a lot of cases is there's some consolidation that's starting to come to a head. You've got people on both sides that have been fighting over something, and you've got a sense whether it's sort of intuitive or instinctive, or if you've got some system for it. And you talked about technical indicators, perhaps is more systematic. For me, it tends to be more intuitive, but basically I can see where the balance of power is tipping in that consolidation. And the trade is before the breakout to trade the breakout. And then it's the flush of orders on the breakout that's really the meat of the trade. And it seems like a lot of the setups that you posted have kind of followed that basic philosophy. Would you say that's fair?
Yes, absolutely.
Yeah, okay.
And yes, there's a risk here. Like you said, I definitely try to anticipate the breakouts. So,
Yeah.
Obviously you got to be, careful and have your stops in place, especially in options. Cause if that triangle goes south rather than north on you and you're on the wrong side of that can turn quickly. But yes, I am trying to anticipate the breakouts.
So that and what you just said really goes into my question. And my question is, and this is if you do that kind of style, everything comes down to how you gauge your risk, because you can be wrong. And so I'm curious, when you're dealing with options to try to implement a strategy like that, do you think are you using like a ratio in terms of risk reward? Because it seems like maybe not, and maybe you're maximizing like a winning percentage based on where you risk, or are you structuring your setup so where you place your risk? And I know it's different with options and you're looking at the premiums, but still in dollar amounts. Like, are you thinking in terms of like 3-to-1, or are you thinking more in terms of like, let's get 80% right?
Yeah, so it's, you know, and we're going to take a deeper dive into this because Dave and I have been talking. I think, you know, stopping your losses on the options front is probably one of the most crucial things. So, you know, for me, I kind of like actually a set percentage. You know, if a trade starts to dip down where I'm down 20% on options, I'm starting to say, hey, you know, was I right here? You know, once you get to around a third, I think you got to kind of seriously be thinking, you know, this trade didn't go the right way, and definitely by 50%. So that's kind of how I think about it on the downside. You
I
know,
would call
everybody's
that I would call that falsification. I use the same idea, right? It's
yeah.
just right. It's scientific method. This is wherever you set a definition of falsification of a setup. But I'm curious about, is that play into a ratio for me? The way that I look at it is, it could add up in every way, but then if I say my expected gain on this is only the same as my expected loss where it falsifies. So where I would say I got to toss this out is actually only, 1-to-1 ratio with what I think I can make on it. Then I pass on the setup, because I want to see a larger ratio. I want to see the reward be, 2-to-1, 3-to-1, 4-to-1, 5-to-1 of what I'm going to lose on it. Do you ever think in those terms? I guess that's the main question.
Yeah, I think it'd be kind of the 3-to-1 range for
Okay.
me.
Okay. Yeah.
Um,
Good.
yeah, and then, you know, one thing, I'll give you this one quick example that I actually shared with Damon. He was asking me similar, you know, what kind of profit level are you looking for? And, you know, I try to be careful with putting a specific one of like, I need to hit 100% on this. And I'll give an example. I was on a trade in Marvel Technologies a couple weeks ago. I went into the trade in the morning. Option was up 80%, and it was approaching the mid Bollinger Band or 200-day, whatever it might be. It was my target level. And at that point, the stock market had been up for most of the day in a pretty strong trend. We're getting to around that point of the day where you might see that afternoon profit taking. So I've got a stock that's up pretty solidly on the day. It's approaching my target level. The stock markets had a pretty nice run. We might see some profit taking before the close, and I'm up 80% on that trade. So for me, I said to myself, I'm not going to try to squeeze 100% because I have a specific ratio in mind and I got to hit 100. I took that 80% and I took my money and ran. And, you know, this doesn't always happen like this. But, you know, it hit the 200-day moving average. And sure enough, you saw some selling kick in. So, you know, I was able to lock in that 80%. You know, was it my specific ratio? No, but I entered it at the time that I wanted and I got out of the time. And, you know, frankly, I was pretty happy to take home my 80%. And, you know, for something like that too, I realized that I'm kind of on the strong stock, take my breather, and then you can maybe have it kick back a little bit and pull back, and, you know, maybe you can re-enter, and then you can adjust your strike accordingly if you know, still see more upside. So I try to be careful there. I don't want to enter into a trade and say, I got to hit 100. I got to hit my ratio, because things will change. And especially in options world, you know, if one of these breakouts occurs, you could quickly hit 50% on your money, and then things could change so quickly. I don't want to sit there and have that 50% go away when I like said to myself, oh, I got to make 75% on this. So those are
And
just things that I am mindful of, you know, as I enter a particular trade.
yeah, no, that's a good answer. And I would say what you're highlighting there is, if you trust your instincts on the entry, you can't be fully systematic on the exit, because you're going to be
Exactly.
sitting there reading the patterns. And that's what
Yep,
you're doing.
exactly.
Yep.
And I suppose the other thing to take into consideration is if your hit rate is better than 50%, then you can have a 1-to-1 correlation.
Yeah, absolutely. I mean, you know, again, if you stop at a third and you're hitting 50% on an options trade, yeah, no, you're absolutely correct. And, you know, I don't want to, you know, sound like a, you know, social media trader here, but I mean, you can make very good money if you hit an options trade correctly. And, you know, if you let that run and you manage it properly and trim and roll, I mean, you can definitely cover your losses. But, you know, with options, the biggest thing, and I learned at a very young age very quickly, options losses add up very, very quickly. That is the biggest thing that I would stress to anybody who's thinking about picking up, you know, a book to start learning about them, is the losses on options can absolutely destroy you.
All right, so it sounds like you'd be willing to do some option tutorials for us. I know that there's a lot of interest in this, and I've warned many of our listening base, if you don't really know what you're doing in options, then really do some homework. But it's good to have you on board, especially if you're willing to be a teacher of some of these concepts, if that's something you'd be interested in helping us out with.
Yeah, no, absolutely, Jim. And I would add to what you just said of kind of not touching them if you haven't done your homework. I mean, I said earlier, I've had some friends that have asked me to teach options, and we were in day 3, and they decided to jump the gun because they were excited. And one day, stepped away from my phone for 5 minutes, and I looked, and I had 5 missed calls from a buddy of mine, and he said, "Hey, Brandon, I just bought some NVIDIA calls. How do I close this position?" So I
Mm,
quickly walked him through it, and then I said, "Hey, look, you need to know how to close a position and how it works." I'm like, "You could have just lost your $2,000 that you put into that instantly." So I would definitely stress, and don't listen to the social media post of "I can teach you options in 5 minutes and you're going to be driving a Lamborghini." You really, really need to do your homework on these and understand the basic fundamentals before dabbling in them.
And can I add one little metaphor? I always like to tag into a derivative statement like that. For anybody listening to this, for anybody taking his calls, or for anybody taking my calls in the futures, it's the very same principle. Trading shares is using a handsaw. Trading derivatives is using a chainsaw. So there's a lot more care that needs to go into that.
Yep, I would agree.
for sure. All right, Brandon. Well, we're going to be hearing a lot more from you, particularly hopefully next week we'll get you on and take a deeper dive. We'll have a recorded session in which people can go back and listen to it over and over again. But definitely glad that you're on board with us here today and giving us some insight into your mind and how you trade. So it's very exciting. So I want to thank you. And I'm sure I'm speaking for our listening audience as well, because I'm sure you've made them some money.
Thanks, Jim. Appreciate the time today. And yeah, look forward to working with you and, everybody on the team.
For sure. All right, Scalp Trader, you're next up to bat. So you've been a little more active in the day trading. I even saw you buy some options yesterday. You're getting a little more diverse as far as some of the things you're doing. What's going on in your world?
Yeah, I think after spending the past 3 weeks hanging out with Brandon, getting him onboarded onto the team, I've spent a lot of time looking at options, and Tesla is just one of those names that I saw set up in. I didn't want to short the common shares. A lot of these names, you think they're going to go down, but you don't want to be short the common in case some news comes out and causes them to gap up dramatically. So after looking at options chains all day for the past 3 weeks with Brandon, decided to actually implement a trade in the Tesla puts, which played out pretty well this morning. But my focus really has continued to be on, looking for ideas in terms of kind of portfolio positioning, which to me is an important piece of of my focus. I think that, if you can put your portfolio in place and make money on your core capital, then the trading part of it is fun, and just kind of a second piece of the opportunity. And so I've been positioning, kind of been talking up the private credit markets and the private credit opportunity a lot over the past several months. And I wrote a comment I think yesterday, giving an update on some of the companies that reported earnings and some of the preferred positions I've been buying, and how they've actually outperformed the Nasdaq over that period of time, even with this huge run in the Nasdaq. And so I think once you also look at the fact that, I know for me personally, I'm willing to put a lot more money into a commercial REIT with a 12-13% yield, or a preferred with a 9-10% yield, than I'm willing to put into Meta or Tesla or whatever. So once you factor that in, you look at a stock like Tesla, and I think, on an overall basis, on a dollar basis, some of these preferreds have outperformed the move in Tesla, just in terms of one being willing to put more capital to work in these names. And, the year's just started. You haven't even collected your 10, 11% coupon yet. So I'm pretty bullish on that market. I wrote a comment this morning talking about how I'm trying to move up the capital structure. A lot of these names, especially like the commercial mortgage REITs, are seeing some real issues with their office exposure, and they're having to build reserves to deal with that. A lot of them have about 25 to 30% or more of their exposure is in office, and office is terrible right now. Office is absolutely terrible. And you're starting to see some of the sponsors game the system. They understand that the lenders don't want to take losses on these loans. And instead of when the lender comes and says, hey, can you input more capital into this deal? They're taking a step back and looking to negotiate some terms in their favor, such as writing down some of the loan, and just better terms for them and with respect to the overall loan structure. So for that reason, I'm stepping back a little bit. And I've been warning of this for the past 3 or 4 months, that office is terrible, and anyone with office exposure, you better be careful of. But I see the opportunity here as well. So I'm moving up the capital structure in some of these names, let the individual shareholders duke it out over, book value each quarter, or the reserves taken each quarter, whether the common share dividend is going to be lowered or raised. They can duke it out. I think that the common shares are going to see a lot more volatility this year and could see some downside price action. I like the preferreds. I like the bonds. I'm starting to see show some interest in the bonds of some of these names as well. And I think later in the year, you'll be able to come back and buy some of these names at 15, 16% yields and have compelling capital appreciation potential of 20, 40, 50% on some of these names. And so that's kind of my area of focus right now in terms of the core portfolio. And then with the individual day trading, just, looking for opportunities wherever they present themselves.
All right. Anything outside of that you're going to be looking at? Outside any other asset classes is what I'm gathering.
I think there's enough opportunity within that asset class that kind of keep me busy. So my only interest is really just making money, and so I think you can go have fun in other places, but when you're dealing, and this is I kind of become like a disciple for these like kind of REIT and high yield asset classes, because it's a space that you can put a lot of money to work and sleep at night and collect a fat dividend, and then you always get enough volatility and enough movement, especially in periods like this, where there's opportunity to go in and buy distressed, right? And so, like I was talking about the Ladder today, like Ladder reported earnings last night, and like that position, I'm up like 230% in. We bought it on the site a few years ago, but at our purchase price, it's yielding like, I think, almost 30%. All right. So there's opportunities every couple years or so to really kind of dive deep into this asset class. And there's enough volatility and enough, different parts of the structure that you can really find compelling opportunities. So that's where I'm focused right now, because I don't know, I believe in that, finding opportunities that you really feel comfortable going after and maximizing your return versus kind of tiptoeing into things. And I think there's a lot of things out there that you have to tiptoe into because you don't know it, right? And like I was watching an analyst the other day on CNBC talk up a stock, right? And you could just tell, like, this is an analyst covering the name, from a major firm. And he was just full of shit, right? Like you could tell, like he had no clue. He was just kind of throwing stuff against the wall, hoping people would buy it. I don't like that for my type of investing, right? Like with tech stocks, I think that most of the time they're overvalued until they're really, really undervalued. And so, like, I like them then when they're really, really undervalued, but most of the time they're kind of overvalued. And so, I'm more of a relative value type of investor. And so just looking at kind of take advantage of, market situations, market opportunities. And right now, I just think that the private credit space, the commercial REITs, the BDCs, the preferreds offer super compelling opportunity, and will continue to do so over the next 12 to 24 months, as well as the distress side of things.
All right, Damon. Well, not only do I not have a drum roll button, I don't have a censor button either. So I won't be letting my 10-year-old listen to this call. I'm just kidding. But I think Brett had a question for you, though, Damon.
Yeah,
Yeah,
actually, I
sure.
do. Okay, so I'm going to make a statement and then ask you a question. So the statement is, one of two things is true. Either there will be no cryptocurrencies in the future, or Bitcoin has bottomed. And the reason that I say that is because we had this long, drawn-out bear market, really classic signals. It was already down 70%, and then the FTX blowup came out. And that's really one of those moments where there's just no weak hands left in there. Can't be. So if it's not a permanently crippled idea, that is the cycle end of that thing. And the story has begun of the wall of worry, and before people get excited 2 years later when it's at 50,000 or whatever. So one of those two scenarios is true. I'm going to make that premise first. And then I'm going to ask you, do you have any interest in that space at all anymore? Because you used to have a lot of interest there.
Not really. I mean, I probably traded that space around the clock.
In 2017, it was,
Yeah,
and you did awesome. It was amazing.
2017, 2018 for probably about 9 months. I mean, basically going, I don't know, 16, 17 hours a day. I mean, that market never closes. And a lot of the opportunity occurred on the weekend. Over the weekend.
Mm-hmm.
So, I mean, it's just an example of like, you have these pockets of opportunity that pop up, and you just, you have to jump on them before the window closes. And oftentimes the window closes within 2 or 3 months. And so you really have to ideally be prepared by doing the research on some of these things and trying to understanding them in advance. But so when you have this uptick in volatility, you're prepared to jump on them. But in terms of crypto, the thing that I liked about crypto at that time was just the inefficiency of the market. And it reminded me of trading in during the .com period.
90s, yeah.
It was just complete inefficiency in the market. I mean, during that period of time, right, a company could announce a 2-for-1 stock split and the stock would go up 100%. And if they announced a 4-for-1 stock split, the stock might go up 200%, right?
Mm-hmm.
And so there became a chase to see a competition to who could announce the biggest stock split.
Sure.
You start to see 7 or 8-for-1 stock splits. With crypto, I feel like it's really a scam right now, honestly.
Okay.
So
scenario one.
Yeah. I always thought it was a scam, but
Right.
You could trade it and find opportunities there. But now it's become so institutionalized that you're basically dealing with algos and crypto as well, and there are projects that pop up literally every few seconds. So I think when I started trading crypto, there was maybe, I don't know, there's hundreds of cryptos. I mean, I think now there's probably 10,000 crypto. I mean, there's thousands and thousands and thousands.
A glut.
Yes.
So what I could extend it further. So I guess where I was going to go, if you said the other answer is, it is a value market then. If so, let's say Bitcoin, it's still viable. It's just been a cycle, and the cycle had the extreme of everybody thinking it's inviable. And that would mean that all of these things are these value plays now. Just we don't know how to value them. And there's going to be a time and everybody's excited to get in the future. And therefore, this is this moment where you can build this portfolio that when the paradigm shifts again is going to be this massive payoff. So I was kind of trying to get at if you've been thinking about that at all. In other words, is this, so you say that it was 2017 was like 1999. Is this 2003 for the NASDAQ? For crypto.
I mean, I still have some small exposure, and I've done it largely through, I think I have some GBTC, as well as some of those other funds that are trading at huge discounts to NAV, just hoping that NAV gap will close and they'll possibly be liquidated, but also that even at a 50% or 40 to 50% discount to NAV, they still kind of track Bitcoin and Ethereum. So if those continue to bounce, then, I have some exposure from that
Right.
perspective. But I'm just not particularly excited about that space. I mean, I think that there are some funds out there that kind of give you broader exposure to some of the names that are considered more compelling. But I don't know. I think it really is just gambling. And, the people that I talk to who are involved in the space, I mean, it's really, they're just gamblers as well. And just, think
So
they're
if I,
innovating, but
yeah,
they're really just gambling, I
I
think.
think I can kind of summarize your position then, which is you love to play the distressed value when you could deeply understand the real value, and you like to play momentum when nobody can. Is that about right?
Yeah, I think that lines up with my approach. Yeah.
Okay. Thanks.
All right, Damon, do you have anything else for us that you might be working on?
Well, I guess, one of the things I really wanted to ask the group about is just general kind of portfolio positioning, kind of where, not necessarily portfolio positioning, but just where they see the opportunities this year. Like, where are the kind of most compelling opportunities if you really wanted to spend some time digging into and figuring out, hey, do I really want to allocate some capital in this space? Are there any ideas?
I could jump on that. I mean, basically the way I'm seeing things, Damon, is I'm just kind of riding a wave. I remain bullish overall. So, this hiccup here, I've just been looking to put in some downside protection on using the SQQQs. You could also do some of the put trading that's been going on with the traders here. And that's kind of how I'm viewing it. I'm still of the mindset that I'm not looking to jump out of this market just yet. But putting on some hedging activity to protect against the possibility of downside is definitely prudent at this juncture. I do think that, as I was saying earlier, that most of the focus has been on the rally in tech, which has me a little concerned that a lot more of it could be short covering or just people simply diving in for the January effect and getting those tax loss selling names that were beaten up. And one of the things that it feels like that they've been doing is selling the energy and healthcare space, which I still think has some nice upside. So, energy, healthcare, and financials is kind of where I'm looking at adding exposure here once I feel comfortable that, this current little dips hit a bottom. Watching the Fed closely and just kind of managing things on that side too. But I got that IWM on, which the Russell has a lot of exposure to energy and financials in there, so that's a pretty good place to be right now in that small cap space. So that's kind of how I've been looking at my portfolio and managing it. I haven't wanted to chase some of these tech names that have been on the rise here. And then the other thing that I've been diving into, and it's still a few years off, but I'm looking for some home run investments in the quantum computing range. I mean, everybody's been looking at these AI plays and they've been flying, but it seems like none of this AI stuff's going to take off with until quantum computing can kind of get behind and really maintain the amount of data work that needs to go through and have the GPUs in place that can support that. So that's some of the things that I've been doing for my portfolio and investments.
All right, Brett, anything to add?
Yeah. So when we started this call, I said you could frame things sort of like this kind of binary outcome distribution thing. If you want to sort of digitize it a bit in terms of the outcome slices, it's kind of like a pair of pants. Through the right leg is a universe where Team Transitory is vindicated, and you see basically that there's all these sort of opening ups of supply constrictions. People coming back to the labor force because they can more easily get childcare, and you've got supply chains based in China with them reopening after the virus, and everything kind of smooths out there. Maybe we get a positive break in the Ukraine war, and so you can have unemployment rate of 3.4%, and you still get inflation coming back down to 2%. There's one universe, but through the left leg of the pants, there's the other universe, which is services is going to stay at 7.75%. And you're going to start to see goods and commodity prices turn back around. Team Transitory is just forever in the history books as a disaster of central banking, and we see this scenario that I outlined earlier where you've got, the Fed funds at 7.5% later this year, and we're in a hard landing. If it's that second universe, the best opportunity that there is just loading up on fossil fuel energy resources, to me, because I think that they're going to tank, and I think that there's a structural supply crisis coming in that space. And we've talked about this before. This is the year when that could become the most dramatic undervaluation of the cyclical to the super extraordinary structural, that sort of displacement between those two time frames. And that could kind of come to a head. You've got 15 years of underinvestment in fossil fuels because people are worried about regulators and ESG, and we know that there's a sunsetting of fossil fuels not that far ahead, and yet we know also that there just simply hasn't been enough investment in something viable to fill that hole. So there's inevitably going to come this period where you have nowhere near enough oil to fill the gap, and there isn't something to substitute for it. That's 5 to 10 years out. It's utterly inevitable. And there's positioning for it, and I don't know how. You're just not going to have people invest a lot of money in developing some major new oil deposit into some producing facility over the course of 5 years and billions of dollars. Instead, I wouldn't be surprised over the next few years to see the existence of hedge funds that start up just by saying, here's our premise. We're raising money right now. Give us lots of money. What we're going to do is we're going to get lots of barrels of oil, and we're going to put them in a storage facility where land is cheap and just sit there with them for a decade, or in a ship, that's just going to sit in the Arctic for a while. Like, instead of investing in producing something, you've got an exit within the window of the time frame there. But that situation, if you suddenly see oil stocks and oil itself and other derivatives and anything fungible to it and anything coordinated with it, except for the oil services companies and the suppliers for drilling and exploration, just everything that's just about the actual oil itself. If that all tanks because we head into this hard landing, then just absolutely filling up on that would be the best possible opportunity that could happen this year, in my opinion.
All right.
I have to say I'm intrigued with that, Brett. I know, what was it? Was that during COVID that oil went below
-40?
Zero? Yeah, negative oil. I mean, it's just another example of distressed opportunities. Like I still own stuff that's up like 1,000, 1,200% from that period of time, like 3 years ago. It's paying just ridiculous yields. So always, and we've had a couple major kind of oil periods. I think oil crashes. I think 2016 and 2017, we had a lot of
2014,
oil.
2015. Yeah, that was
okay.
That was fun times.
That was a good period as well.
26.
Yeah, so that's I was watching something the other day, kind of it's similar to your premise, Brett, of someone creating a fund to go buy interesting assets and very focused on those assets. And they were buying, I think it was land in, not sure if it was Colorado, along one of like a major river, and they were just buying the land along that river. Yeah. So for the water rights.
The climate change plays are interesting. Like somebody buying a giant part of Greenland would be another version of the same kind of idea, right? Like it's just this is going to become way more valuable because things are going to change. But yes, that's a good point.
Yeah. So I kind of wonder with office, I don't know if you guys can see office ever coming back, but office I think could become a distressed asset here pretty soon in terms of the publicly traded stocks. There's like literally, you listen to these companies on their calls, they're like, there's just no market for office, right? They can't, they're unable to get new loans to refinance their loans. Values are falling. And so that's one space I'm paying attention to is the office space, just because the prices have fallen for the publicly traded stocks dramatically. The yields are pretty high, but you're starting to see some talk about conversion of offices into, into like condos and
repurposing. And sure.
Yeah, even though I know it's very expensive, but that's one asset class I have on the radar.
David, let me ask,
perspective.
Would like a SLG, SL Green be a name that's on your radar then on that? Or what are some of the bigger commercial plays out there?
Exactly. But I don't think that the pain is over yet. It just seems like it's going in one direction, and right now the market's kind of frozen, and no one wants to touch it. So, if you start to see a situation where maybe some of these companies get into trouble because a lot of them have a lot of debt. Most of them have lots of debt. They're going to have trouble potentially rolling over that debt. So there could be some opportunities there. Maybe a general growth properties type of opportunity down the line.
Very interesting. All right. Hey, Brett, I want to get back to something that you mentioned earlier, and you were talking about the McClellan Summation Index. You were kind enough to send a chart for us. So why don't we go over that while we have you on board, and you can kind of walk us through this chart that we're looking at here on
Sure.
the Trader audio screen. There we go.
Okay. Yeah. So I mean, just look at the red dots. The situation that I described earlier, where it goes from negative 1,000 to positive 1,000 over in a single sequence, is very definable. It's not ambiguous at all, and it's really like short-term breadth is accelerating to the downside faster than long-term breadth, but both are negative. Shifting to short-term breadth is accelerating to the upside faster than long-term breadth, and they're both positive. Pretty much defines that situation, and that's happened 18 times over the last 50 some odd or 60 after the past 60 years. And if you look at the red dots, that's each time it's happened. And one thing that I point out when you're looking at this is, so those pink vertical zones
Mm-hmm.
are anything you could ever call a bear market in this chart. Anytime there's been sustained downside movement, I'll just say there's no red dot inside of a pink thing, right? Never, not one. And there's a couple of red dots inside of an existing uptrend, right? That happens here and there, but for the most part, the vast majority of those red dots are right after the end of a pink vertical line. Like, I mean, the first and every single one of those pink vertical sections has a red dot right after it, and there's no red dots inside of them. Okay, that's the picture. That's a fact. That's just a fact of the universe. There's no way to argue with it. It is a true fact. It's based on data, and it's based on data that includes, all stocks across the market, and over a long period of time and a sufficient sample size. So, I mean, again, I can say, hey, look, you can chalk this up to data mining, or you can say that could be different this time. This is still a fact. This just happened now. You can see the latest red dot just happened. And I could draw one of those red zones around what happened last year real easily. And you look at what happens after those red dots. So that's just a fact of the universe right now that we have to contend with.
And based on this, it looks like there was only one in which there was a really, I don't know, kind of a shorter period of time. What was that? Maybe 1981, 1980 into the.
Yes, but coming after
See
an
that one?
established period of upward trending movement.
Right, which is kind of what we have seen, I
Well, not
guess,
over the
because,
last couple years. I mean, we've seen a few months of upward movement inside of what people would probably mostly consider a bear market that still is in play. I mean, that's my frame of reference, and I
yeah,
would
well,
say that is several years after the end of a previous bear market in that previous instance, and sideways ranging kind of upward trending period for a few years, and then we see one of these signals.
well, the one that I'm looking at is this time period, that's, I don't know, maybe 1975 to the 1980 period.
Hmm.
That looks the most similar to what we have right
Which
now.
one put the?
So back, are you looking at the Trader audio screen? So
Yes, I am, but I don't
so
know if this.
C 77.
I see there's two dots close together after the 74, 75, 76 area
Right.
bear market.
And so it's not going to be perfect. This the most recent orange vertical bar that I see here.
The pandemic, yeah.
Yeah. Okay. So that's a pandemic, and I almost want to. It's very
Discount it.
short-lived.
Yeah,
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 I
you
want to
can throw
discount
that out of
that
the
one.
sample for sure.
And here's the thing, that time period, wouldn't the late 70s into the early 80 time period be the most similar
Well,
to
inflation
what we
data,
have?
sure.
Right, exactly, to what we have now.
I mean, yes, except there was a very high unemployment rate at the same time. Then we got the lowest all time right now. So there's a big difference there. But I get what you're saying. An inflationary dynamic that puts monetary policy on the other side of the game, and that's the biggest factor that we're dealing with. Um, but so I would say I'm still having trouble which data point you're picking out. If it's the one that precedes the 1981 bear market, which
Hmm.
is really the only one where there is any bearish movement in the 6 months that follow, or are you saying the one right after the 75 bear market?
I'm looking at the time frame in between 1975 into the 1980, and I'm looking at that
There's
as
3 red dots there. Which one of
right.
those
There's
3 red dots are you pointing out?
that whole time period, that 5-year time period, or
Oh,
whatever
okay.
time period
But
that
there's
is.
3 different signals from this indicator in that period.
Right. Well, there's 3 different signals, actually 4 different signals if we discount the pandemic.
No, I mean, I see.
And we're
I see.
entering into an inflationary, or the same type of the closest thing we've had to that inflationary state in our modern time versus
Except for the
the
pattern.
early 80s.
We have a bear market over the last year, which means only the first dot in that 70s chart would match the one we just saw to me, because it's coming out of a bear market. I mean, we had a bear market last year, right? So the third dot in that series doesn't really fit that analog to me.
Okay. All right. Well, I'm just trying to come up with the most similar thing that I
No, you're
can
right.
with the
And in
first.
the larger sort of, big time frame situation, the fact that we've got the first time, we have seen there's all sorts of data points that line those two periods up very well. Yeah. So the CPI changes obviously are the main one, but we've got monetary policy on the other side of the fight, and that defines those two periods, and it doesn't define basically anything that came in between, and that is definitely significant. But I would say that even in that instance, when you had a bear market during that environment, the first time you got this signal right after it was a great time to be long the market.
Okay. I wonder why they didn't put one of those orange vertical bars then right next
I
to.
put those orange vertical bars there.
Oh, you did. Oh, well then.
The chart was complete in every respect other than that, and then I added the
Gotcha.
orange vertical bars
Ah, okay.
just to
Fair enough.
identify where the downtrends are.
Okay. Yeah. Gotcha. Gotcha. Okay. I see exactly what you're
But
saying.
the main
So I
point
think
again
that's what
is
threw me off a
there's
little.
no red dot inside of one of those orange stripes.
Right.
Okay, that's the main point I want to point out. If you're going to make the bearish argument now, if you're going to say we got another leg lower, it would be the first time we have an orange stripe with a red dot in the middle of it. Because clearly, if the market turned down and tanked back to 2,900 on the S&P, the orange bar we drew over the last couple years would not stop in December of last year. It would just cover that whole period. It would be a wiggle up that we've seen over the last few months. And it would
Right.
be a sustained bear market with a bounce in the middle and a sideways range and then another rollover. And that would be the only one in that sequence where you get one of these signals before a follow through leg for an existing established bear market. And I'm not saying that's not going to happen. Again, this is just when you look at past data, like this is you could find I could find a probably some chart I could put up of so who knows what, like some kind of meteorological formation that always leads to a bull market. I mean, like, who knows, like the stars, like when the moon is lined up with Mars, like it only happened 18 times in the last 60 years, and every time the market went up afterwards, and it doesn't mean anything. And when you data mine, you find a lot of data points that can't necessarily be relied on because they don't necessarily mean anything. In this case, though, we're talking about breadth underneath the market and a pattern of how many stocks are moving which way over a sustained period, because it's a summation index, not the oscillator. So it's a sustained shift in breadth. And I think this is a large sample size, and I think this is enough instances and over enough period of time that it's far from meaningless.
Yeah, and I get you there. I was just trying to maybe equate one time period fundamentally to what we're seeing now, and seeing if there was anything there that might be maybe a short-lived bull market into maybe a giving some caution, only because of the time period that we're in
Sure. No,
this
and you're
inflationary
right.
environment.
If we look at the 70s as a whole, yeah. I mean, if I could come up with devil's advocate to everything there that kind of lines up with what you're saying, it would be that let's say this indicator is able to hold up in terms of its historical validity, but it really is just like another few months of upside, and then we get another bear market. And in the 70s, you did kind of see a little bit of that pattern.
Yeah.
But that's still a reset and a kind of monthly chart range, which is still not really a vindication of the extreme bearish position right now.
For sure. All right. Well, I do appreciate you clearing that up for me and providing that chart. It's a great data point. So I do appreciate that. We could wrap things up unless anybody has any parting shots.
That's it for me.
All right, gentlemen. Well, we set the record for the longest strategy session. So hopefully we gave you some good stuff to chew on. I know I got a lot. I'm going to be listening to this one again, probably a couple of times anyway. So I want to thank our team for joining us. Thank you all for listening. I will have the replay of this as soon as I possibly can. And I want to wish you all, everyone out there, a good day.
Okay. Have a good weekend, everyone.
Yeah.
Enjoy the
Take
Super
care,
Bowl.
guys.